Eric Robertsen, Global Head of Research at Standard Chartered Bank. He joins us from Sydney. Eric, great to see you. Thanks for your time. Can we start with the fiscal position? Where would you say, on a global basis, it is most precarious? And does it therefore stand to reason that Janet Yellen's calling for a global minimum corporate tax rate?
Well, look, Sri, one of the things that we have all been thinking about and anticipating is that the cost of supporting global economies through the COVID crisis is putting just an immense burden on fiscal balance sheets. We've seen a significant increase in debt issuance last year. We're seeing increases in fiscal stimulus this year. But at some point, that has to be paid for. And we're seeing this now in the United States, where Biden has proposed his infrastructure plan, but they're also talking about how they're going to pay for that with an increase in corporate taxes. Now, as Janet Yellen's talking about, the ability for large multinational corporations to move their domiciles around the world and potentially reduce tax makes tax collection a lot less efficient. So I think what we're really talking about here is laying the foundation for a minimum corporate tax rate that allows governments to shore up their balance sheets, which is going to become the next part of the sort of COVID recovery cycle.
And complicating the matter further is the conversation domestically in the United States relating to the rise in corporate taxation rates to 28%. Is that warranted, Eric, or is it going to be anti-competitive?
Well, look, I think it is warranted. We can debate the magnitude of the tax increase, whether 28% is the right number or 25 or 30. But I think what the Biden administration recognizes is if they're going to get through another big fiscal package after already passing nearly $2 trillion of fiscal stimulus, they have to find a way to pay for it. And we're seeing early discussions about an increase in corporate taxes, an increase in income tax, and estate tax. Now, the other side of the debate is whether the U.S. economy, with the expected recovery that we're going to see, needs all of this fiscal stimulus. Now, I think most people would argue that the U.S. economy needs the infrastructure spending. Whether it has needed the income support that we've seen in the last fiscal package, I think is up for debate. But there's no question, Sri, that the cost of these fiscal stimulus bills around the world, not just in the U.S., is going to put increasing strain on sovereign balance sheets. And that's why we've seen yield curves steepening so much over the last 6 months.
Okay, I'm glad you brought the yield curve and interest rates into this conversation, Eric, because I wanted to talk to you about that. I mean, the problem is we've got this mountain of debt built up, which is even bigger now because of the coronavirus. And, the fiscal stimulus, the spending is absolutely needed and crucial. Nobody's going to argue with that. The question is, how do you pay for it, right? So we've been talking about raising taxes. That's one way. The other way, obviously, is you could do more debt issuance, which we've already seen. Are we, though, reaching the limits for central banks of being able to hoover up this kind of money to keep rates reasonably sane? Because when you take a look at the situation in Japan, which still far and away has the highest public debt to GDP ratio in the industrialized world, they've literally already nationalized the stock market, ETFs at least, literally nationalized their own bond market. I mean, this is doable, of course, but sustainable, I don't know, because it leads to just a price distortion, does it not?
Well, Martin, I think the point that you raise is an incredibly powerful one. And you refer to this balancing act that we've seen governments and their central banks engaged in. Now, you're absolutely right. Global debt went up by about $20 trillion last year, roughly 290 trillion in total. And what's interesting about that is many people have argued that increase in debt outstanding is sustainable as long as interest rates remain low. But as we've just seen over the last 6 months, when 10-year treasuries go up by 100 basis points, back of the envelope, that tells you that the amount of debt servicing costs have just gone up by $3 trillion. Now, in a world where global economies and global corporates are trying to dig their way out of the COVID-related recession, that increase in debt servicing costs potentially becomes problematic. And as you correctly point out, that's where the central banks have had to step in and absorb some of this debt issuance. Now, the G10 central banks seem to be able to do that without undermining their currencies. We've even seen some of the emerging market central banks engage in domestic open market operations. And so far, that hasn't caused a problem. But it's because inflation remains low. And even with the volatility we've seen recently, interest rates historically are still low as well. But if inflation were to shoot higher, driving yield curves even steeper, I think this delicate balancing act that you refer to might come under some scrutiny.
Yeah, indeed. And if vols can get back to spiking as well, wouldn't be very constructive or helpful either. Eric, listen, stay right there. A lot more to talk to you about coming up in just a bit as we continue with Eric Robertsen, Stand Chart Live.